Well, by far the best investment you can make is in yourself. If you invest in yourself, nobody can take it away from you. I mean,
Today we will explore the valuable lessons from Warren Buffett on investments, focusing on his perspective on the major companies in the world and the dynamics of the market over time. Get ready to understand how the history of the largest corporations can teach us to navigate the complex universe of investing. Don't forget to subscribe to the channel and turn on notifications so you won't miss any essential tips that can transform your financial strategy. And now, let's go to the video.
At the beginning, I want to address 2 points that I consider essential for new investors entering the stock market. As they observe this dynamic environment, many find themselves tempted to execute several trades daily, believing they can achieve quick profits in what seems like an easy game. Therefore, I would like to share a reflection before they take this path. I will start by showing a slide prepared on March 31st, which presents a list of the 20 largest companies in the world ranked by market value. Many of these names will be familiar to you, with Apple leading the list at over $2 trillion, while the company in the 20th position was valued at around $330 billion. What is interesting about this list is that among the 6 largest companies, 5 are from the United States. This leads us to consider the current situation of the country and the role of American companies in the global landscape. We often hear criticisms about the performance of the United States, questioning whether the country is still a growing economic power. However, the fact that 5 of the 6 largest companies by market value are based in the US is an impressive statistic, especially when considering the historical context. If we look back to the year 1790, shortly after the independence of the US, the American population was a tiny fraction of the world's population, about 0.5. The country then had approximately 4 million inhabitants, of which 600,000 were enslaved people. For a comparison, Ireland had a population greater than that of the US. At that time, Russia had 5 times as many inhabitants, and Ukraine had double. In fact, the demographic and economic situation of the US back then was very different. But there was something that set the country apart, an aspirational plan and a vision for the future. Just 232 years later, the American system, with its values and economic structure, resulted in 5 of the 6 largest companies in the world being headquartered here. This was not a coincidence or mere chance, and it certainly did not happen because Americans were stronger or smarter than other peoples. In reality, we had good soil and decent climate, but the same was true for many of the countries mentioned. What truly made the difference was the economic system and the entrepreneurial spirit that consolidated over the centuries. Therefore, as you observe this list of companies, I invite everyone to reflect. How many of these giants will still be at the top in 30 years? We are looking at some of the largest business powerhouses today, but history has shown us that the market is unpredictable. Few of them will maintain the same status. Think for a moment and make a bet. How many of these companies will remain among the top 20? Make your own guesses. When we examine the sustainability of today's largest companies, we encounter an intriguing question: how many of them will still be at the top in the next 3 decades? Looking to the past, we see that the dominant position of companies in the market can be as transient as it is unexpected. This becomes even more evident when we analyze the list of the 20 largest companies from 1989. Surprisingly, none of the companies from that time remain among the top 22, a fact that few predicted, reinforcing the volatile and transformative nature of the market. In 1989, there were 6 American companies among the largest in the world. These names included giants like General Electric, Exxon, and companies that still exist but have lost their prominent positions in the global rankings. While they are still recognized in the market, none of them are at the top anymore, serving as a clear reminder of the dramatic changes that can occur, even for those companies that seem unshakable. If 30 years ago, someone had made a list of the companies that would still be among the largest today, they probably would not have written down zero as a response. Another relevant point is the presence of Japan on this historical list. For a long time, Japan experienced a rising market, resulting in the inclusion of several Japanese companies among the largest. Today, however, none of these companies remain among the largest in the world. In contrast, while the United States had 6 companies on the 1989 list, it now counts 13, although they are not the same 6 from the past. It's interesting to remember that 1989 was not a period of economic uncertainty or a dark age. At that time, theories of market efficiency and the understanding of the stock market were already widely accepted and discussed. The mentality of the era was confident, with many believing that the market was predictable and comprehensible. In that year, the largest company in the world had a market value of about $100 billion, while today the highest value reaches an impressive $2 trillion. This significant increase, both at the top and at the bottom of the list, reflects a series of profound changes in the economic landscape, including wealth disparity, issues of equality and, to a lesser extent, inflation. These numbers demonstrate that capitalism has had an extraordinary impact, especially for those at the top, even though recent years have not been marked by a high level of inflation. As seen in other times, the significant increase in the value of companies shows how capitalism can be particularly advantageous for capitalists. Furthermore, this growth raises the question of whether, in the next 30 years, we will see something similar. Will the leading company be able to reach a market value 30 times greater than its current one? It seems unlikely, perhaps even impossible, but this uncertainty is part of the nature of the market. This history reminds us that, no matter how predictable we might believe investment, trends and company performance to be, the market remains a place of constant transformation. It is a scenario in which companies that dominate today can become distant memories in a relatively short future, reminding us that sustained success requires more than simply being in the right place at the right time. Throughout history, the trajectory of various industries illustrates how promising sectors can attract an impressive number of companies, but only a few manage to establish themselves as leaders. A clear example of this is the automotive sector, which has undergone radical transformation since its inception in 1903. That year, when my father was born, the environment was favorable for the emergence of automakers, especially with the founding of the Ford Motor Company by Henry Ford. He faced some difficulties in his initial attempts, but was about to revolutionize the industry and change the world as we know it. The automobile transformed not only the way we move, but also the social and economic structures of the entire country. Henry Ford introduced the idea of a $5 daily wage, a significant amount that became a landmark for workers of the time. Improving their living conditions, assembly lines and mass production became the norm, facilitating the manufacturing of vehicles and increasing access to automobiles for the population. Thinking back to 1903, it's fascinating to imagine the vision of a future where interstate highways would be common, with 290 million vehicles on the roads of the United States. An observer of the time could easily conclude that the automotive industry was the right path for investment. However, this idea underestimates the complexity and volatility of the market. In the following years, a series of companies emerged in the automotive sector, each believing it could carve out its space in this new market, believing it was a guaranteed sector for growth. Among these companies was Marlon, which was purchased by the Pritzkers. The name of the company refers to a historical moment. In 1911, Marron's car won the Indianapolis 500, an achievement that brought it into the spotlight. The company also distinguished itself by inventing the rearview mirror, an innovation that, while seemingly trivial today, was a significant advance for driver safety at the time. However, this golden era did not last. Although there was an impressive number of companies entering the automotive sector, only a few managed to consolidate and thrive. By 2009, only 3 major automakers remained, 2 of which eventually went bankrupt. This highlights an important lesson: the act of choosing stocks and investing is not as simple as identifying a promising industry. The history of the automotive sector serves as a reminder that, although many companies may initially seem promising, real success is reserved for those that adapt and innovate. Companies like Maytag, Allstate, and even DuPont attempted to enter this space, but competition was fierce, and many could not survive. What this story teaches us is that, for an investor, it is crucial to conduct careful and in-depth analysis rather than simply following the trends. Over time, investors who understand and prepare for the complexities of the market will have a better chance of standing out and achieving success, even in sectors that seem promising at first glance. The dynamics of the market are filled with surprises and uncertainties, and resilience and adaptability become essential for long-term success. The journey of a successful investor involves much more than just choosing stocks based on current market trends. Warren Buffett's experience teaches us that detailed knowledge and genuine interest in the companies and sectors being analyzed are fundamental for those who wish to achieve significant returns, especially when starting with a smaller capital. Immersing oneself in the study of small companies can become a valuable strategy. When Buffett talks about his own reading experience, he emphasizes the importance of becoming familiar with a wide range of information. He points out that when he was just 20 or 21 years old, he delved into transportation manuals, such as the Moody's Manual, which contained about 1,500 to 2,000 pages. This research was not just a task, it was a passion that fueled his understanding of the railroad industry. He found a world of opportunities by studying the history and nuances of the numerous railroad companies that existed, including the Green Bay and Western, which became an interesting reference in his narrative. During this discovery process, Buffett realized that there were hundreds of railroad companies, each with its own peculiarities. He recalled how each of them had a nickname, which made his reading even more engaging. For example, the Northern Pacific was affectionately called Nipper, while the Green Bay and Western earned the nickname Grab Baggage and Go. These details, the superficial, contribute to a deeper understanding of the sector and the history that shaped these companies. This curiosity and desire to learn are essential traits for anyone wanting to be a successful investor. The passion for the subject cannot simply be about making money. It must come from a genuine interest in understanding how companies operate and what makes them valuable. Buffett emphasizes that to succeed, it is crucial to develop a love for the process of research and analysis. It is the same spirit that a biologist has when seeking discoveries in their field, always in pursuit of knowledge and understanding. He also points out that while he knows great bridge and chess players, such as Garry Kasparov, who was present at one of his meetings, there is a universal truth about intelligence. Even the brightest people can make mistakes in other areas. This highlights the complexity of the human brain and the need to focus on the areas where one is most suited. Therefore, if Buffett had a limited amount of money and wanted to achieve an annual return of 50, he would dedicate himself to studying small companies until he could discover an opportunity that others do not see. This approach is fundamental. Investing requires a genuine commitment of time and effort, not just a desire to make quick profits. In the end, the message is clear. Success in investing is not just about going with the flow or choosing the most popular stocks. It is about research, passion, and dedication to understanding what one is investing in. The pursuit of knowledge, especially about smaller and lesser-known companies, can open doors that lead to great rewards. Each investor should ask themselves, am I truly willing to dive into this world and learn everything I can? If the answer is yes, they are on the right path to becoming successful investors. As we conclude our discussion, it is essential to reflect on the practical recommendations that arise from Warren Buffett's observations on investing. The central message he conveys is the importance of index funds, particularly the SP 500 index fund, as a viable strategy for most investors. Buffett firmly believes that this approach not only offers security but also a reliable path for wealth growth over time. Buffett emphasizes that for the average investor, it is often more effective to invest in an index fund than to attempt to select individual stocks. This strategy allows investors to benefit from the performance of the market as a whole, diversifying their portfolios without the need for extensive knowledge about each company. By investing in a fund that tracks the SP 500, investors gain access to the 500 largest companies in the United States, minimizing the risk associated with choosing individual stocks that may not perform well. It is interesting to note that Buffett, in sharing his investment strategies, also reveals a pragmatic view of what he considers best for his family. He mentions that after his death, 90 of his assets will be directed to an SP 500 index fund, while the remaining 10 will be allocated to treasury bonds. This decision reflects his confidence in index funds as a smart choice for preserving and growing family wealth over time. One of the most important points Buffett makes is that, although he has deep knowledge of the market and companies, he has never recommended Berkshire Hathaway to anyone with the intention of boosting its sales. He is concerned about the idea that people might buy Berkshire stocks simply because they believe he is indicating a guaranteed investment. Buffett has always emphasized the importance of education and understanding the investments people make. He wants investors to comprehend what they are buying and the risks involved, rather than being swayed by advice that may not align with their individual financial needs. Buffett also makes a point to mention that his personal preference is for Berkshire over the market, as he believes that Berkshire's businesses are superior to the average. However, this does not diminish the recommendation he makes regarding the SP 500 index fund. This duality in his approach shows that, even for someone with his knowledge and experience, there is a recognition that the simplicity and accessibility of an index fund can be more beneficial for most investors. Ultimately, Buffett's message is clear: investing should be accessible and manageable, even for those without extensive financial knowledge. The key to successful investing lies not only in choosing the right stocks, but in adopting a strategy that enables growth over time, reducing risks and maximizing return potential. Therefore, for any investor starting their journey, following Buffett's advice on the importance of index funds may be one of the smartest steps one can take in building a solid and prosperous financial future.
And so we come to the end of our analysis of the valuable lessons from Warren Buffett. We have learned that the history of companies and the dynamics of the market not only show us the volatility of the financial environment, but also provide us with precious insights on how we can prepare for the future. The importance of staying informed, conducting thorough research on investments, and being prudent in choosing where to allocate your money are fundamental to success. Remember that the path to financial prosperity is a continuous journey of learning and adaptation. Do not underestimate the power of an index, fund, or diversification in your portfolio. And above all, always maintain your curiosity and desire to learn more about what truly matters. If you enjoyed today's content, don't forget to leave a like, share your thoughts in the comments, and share this video with friends who also want to deepen their knowledge about investments. Subscribe to the channel for more tips and insights that can make a difference in your financial life. Thank you for joining us, and see you next time.